Maximizing restricted stock units. The problem with RSUs. Regulators began to require companies to expense traditional forms of stock option grants starting in the mid to late 2000s. As a result, companies started using performance-based and time-restricted RSUs due to favorable accounting and income tax treatment. In addition to avoiding such expenses, RSUs reduced equity dilution, employee downside risk, and overall complexity of stock awards. The downside of this move to RSUs is that they are considered a form of compensation, taxable at ordinary income rates. This tax is due upon vesting and settlement, which is generally at the same point in time. Once liquidated and converted to common stock, the executive then faces additional capital gains tax when the stock is ultimately sold. It is not uncommon for the executive to be forced to sell 40 to 50% of the shares just to pay taxes. RSUs typically vest in 3 to 4 years, not the 10-year time frame for traditional stock options. This shorter, fixed RSU vetting window results in the loss of control over the timing of taxation. Adding to this problem for the executives, companies can sometimes be lacking when it comes to assisting their executives with techniques and tools needed to help minimize taxes and maximize RSU value. Companies can also be lacking when it comes to educating their executives on the value of their awards. Solutions for RSUs: regaining control over the timing of taxation. Basic pre-tax deferral techniques, such as maximizing one's 401k, IRA, etc., work to offset RSU taxes at vesting. On top of that, a company offering a non-qualified pre-tax deferred compensation plan improves the executive's control considerably. Non-qualified deferred compensation plans, or DCP. 2 major opportunities. 1. Deferrals of the RSUs themselves. An executive may defer RSUs directly into a DCP, and while the RSUs will vest in the 3 to 4 year period, taxation will not be due until a DCP plan distribution date elected by the executive. 100% of the RSUs and any dividends paid continue to appreciate rather than the executive settling for some lesser value if they are forced to sell to pay tax. 2. Deferrals of other income, salary, bonus, etc. A deferred compensation plan provides executives a tool to control how much income is taxed in a given year. Facing a year of heightened taxation when RSUs are vesting, an executive can compensate with deferrals on other income. Here is an example. Tax Savings Option 1 for Ms. Exec. Deferrals of RSUs into DCP directly. Ms. Exec can elect to defer her RSUs directly into the company deferred compensation plan. This allows Ms. Exec to defer the vesting event and the corresponding income tax. She must abide by DCP best practice rules under IRC Section 409A. However, the ability to defer RSUs creates greater flexibility and options for Ms. Exec's overall financial and tax planning. Tax Savings Option 2 for Ms. Exec. Additional cash deferrals to offset RSU income upon vesting. Facing higher than usual income in a year when RSU vest, Ms. Exec elects to defer additional income from her cash bonus that same year. As shown in the following table, if either of the options are taken, or both, along with the fact that Ms. Exec's company had a deferred compensation plan, allowed her to control the taxable income and the related tax in the year the RSUs vested. Looking at the Option 1 and Option 2 columns, both have created a 20% increase over the first column, showing Ms. Exec having no deferral options. In the end, such a significant value to company executives comes at a relatively low cost to the company. Contact us to learn more about deferred compensation planning and its role in recruiting, retaining, rewarding, and retiring the key employees in your organization.